Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to the Quarterly Market Review for the first quarter of 2021. Let's look at some general markets around the world. First, look at U.S. stocks. You can see that they were up 6.35% in this first quarter. The international developed markets were up 4.04%. while the emerging markets were up 2.29%, and global real estate had a good quarter finally, up 6.22%. Now, U.S. bonds were down about 3.37%, while global bonds were down 1.9%. We had lots of big events during this quarter, so let's just kind of review some of them. In January, of course, we had President Biden take office as the 46th president. We also had some GameStop turmoil in that particular period, about mid-January. We also had Bitcoin hit $50,000 for the first time and caused all kinds of speculation as to what that's all about and where that's headed. But we also saw the small cap stocks widen their lead, where the Russell 2000 was up 15% for this year. We'll talk about that several times throughout the quarterly review. Then we saw NASDAQ fall at one point, and we saw President Biden sign a $1.9 trillion relief package. Then we saw the Dow close above 33,000 for the first time. And we ended the quarter with the U.S. consumer confidence hit a new high point since the beginning of the pandemic. Well, when we look at the total market capitalization of all the equities that we hold in our globally diversified portfolio of stocks, it came in at $70.5 trillion. So when we look at the allocation of that $70.5 trillion around the world, we see that about 57% here in the U.S., 13% in the emerging markets, and about 30% in the international developed markets. And that's remained fairly steady since we've been doing these quarterly market reviews going all the way back to 2012. So every quarter we like to look at the asset classes that we have clients invested in here at IFA. And you can see them all listed here with the IFA Index list. And you can see that in the last quarter of 2020, we had a substantial return for small cap value. And for the first time in many years that I've been doing this, we actually have a repeat of the returns from one quarter to the next, where the best performing pretty much continued to perform in the quarter after. So small cap value, as I said, had the highest return. And then in the first quarter of this year, it still continued there with another 25.1% return. Then the second highest return in last quarter is still the second highest return in this quarter, and that's the U.S. Small Company Index. Now, both of these asset classes, small and value, are among the specialties there over at Dimensional Fund Advisors, and are the result of the research of Eugene Fama and Kenneth French, who looked at all different types of characteristics of companies, sometimes called the dimensions of returns. And they concluded that small and value stocks were riskier and therefore should have higher returns for investors. And we went through a dry spell there for a while, but this reinforces the idea that investors need to stay in their seat. They need to remain invested to capture these excess returns because when they came back this time anyway, they came roaring back. And so several investors gave up on this allocation or this tilt towards small value and actually missed out on these premiums. International value also had a great return previous quarter at 22 and a decent return at 11.7 in this last quarter. And you can see pretty much all green there and a very nice pattern from one period to the next. U.S. large value, I guess, is the only thing that's just slightly different. It had a little better return than some of these other asset classes, but still quite similar from one quarter to the next. Now, we'll see what happens next quarter. Fixed income, all this fixed income is very short term in terms of its duration and high quality credit. And so in this interest rate environment, we see very flat returns and actually even a little bit negative for the short-term government in this particular quarter. So as I just mentioned, we've had an unusual return for small and value securities in the last 2 quarters, actually. And so I wanted to review some of that data. We actually started tracking the small and value premium back in September 1st of 2020. And we've been updating it on our homepage every day since then. And here's where we are as of April 9 of 2021. And you can see that small value has had a total return over the 7 months and 9 days of 55.68%, which is very substantial for any asset class in a 7-month period. While large growth had a return of just 13.27 in that period for a difference of 42.41. So those are the 2 primary contrasting asset classes here. You have a size difference and a value growth difference. And so this difference is fairly important. And as I noted, we haven't seen this positive difference for the small value premium in maybe 5 years, and then all of a sudden it comes back with a vengeance. So when we just look at the size premium from small to large, it's not quite as big. It's 24%. And large value to large growth, so just the value premium among large cap stocks, you see here that came in at 15.72 difference. And then if we go down to microcaps here, those are the real small cap stocks. And in fact, the first fund that Dimensional came out with was a microcap fund back in 1981. By the way, they're celebrating their 40th anniversary this year. And here you can see the difference between microcaps. That was at 58.33 versus large cap at 20 had a 37.73 difference. And then among small companies, if we were to look at value versus growth, we can see that it was 55.68 versus 34.4, or a 21.27 difference. So those are substantial differences, and just a reminder that investors need to stay in their seat. They need to hold on to these asset classes to capture the long-term returns. Now, instead of looking at all the pieces of a portfolio, it always makes more sense to look at a whole portfolio. And now you see a nice repeating of our pattern where we had positive returns in Q4 of 2020 of 21.99. We also saw positive returns in this quarter of 13.69. And as you dilute those equities with fixed income, you can see that you can have a nice pattern of a reduction in return, less risk, less return. Dalbar just came out with their new study, and so we did a new chart on that, and I thought it would be a good time to review that with you for this quarterly review. Dalbar has been looking at what we call the behavior gap for investors for almost 20 years now, and they are basically measuring how does the average investor do versus a buy and hold index or a diversified portfolio of indexes. And so we have some comparisons here. And what you see is that the average equity fund investor over this 20 years had an estimated return of about 6%. But if you looked at a simulated IFA SP 500 index, which is similar to the S&P 500 but not exactly the same, you see that it came in at 7.43%, while a globally diversified portfolio of indexes came in at 8.29%. And inflation over that period was 2%. So you don't want your average return to get too close to inflation, and you can see that if you give up any return, you're just getting a little closer to inflation over that period. And inflation's a little bit on the low side. If we look over the long haul, it's closer to 3%. Now, if we look at that data on the growth of $100,000, you can see that that average equity investor grew to about $318,000 versus an IFA SP 500 at $419,000. While that globally diversified small value portfolio of equities grew to $491,000. Now, it's always good to look at the growth of wealth of various asset allocations. And for this quarter, we have now reached 93 years and 3 months. And we can see here the growth of $1 over that period. Starting way back in January 1st of 1928. And over that whole period, if you bought and held and rebalanced, your hypothetical back-tested performance growth of $1 would be $19,044. And then if we dilute that with fixed income, so for example, a portfolio is 75, it drops to $6,095. And if we looked at a 1-month Treasury bill over that same period, very safe. In fact, the definition of zero risk among investments, it comes in at $20 over that particular period. So that wraps up our quarterly market review for the first quarter of 2021. Thanks for watching, and we look forward to seeing you next time.